Good afternoon, or whatever time of day this may find you. This is the Hartnett Flow Show walkthrough. This was a particularly daunting task this week, and we decided to, since it was so torturous, we've decided to change it a little bit and return the favor to Michael Hartnett. So I think if you're a fan of Johnny Carson and a person who's interested in finance, you might get something out of this. Uh, we'll get right into it. You can see we've changed the color tone for today just to break it up a little bit. Hartnett's weekly report is presented two ways: video walkthrough with commentary, and Hartnett's main points are broken out on the right-hand side below. New subscribers are encouraged to listen for translation of Michael's particularly peculiar and borderline obnoxious writing style today. His brand of lingo, I should say, and the Goldfix nuanced take of his excellent analysis. Okay, so here we go. The title is Run Tariffs, Run Tariffs, Run, Run, Run. Our title is tentatively in a message directly to Michael Hartnett. Johnny Carson says hello. That'll make sense as we go into this. Scores on the doors. So gold, 28.4%, government bonds, 6.1%, investment grade bonds, 4.7%, high yields, 3.2%, cash, 1.4%, stocks, 1.0%, commodities, minus 5.1%, US dollar, minus 8.2%, oil, minus 19%, crypto, minus 25.5% year to date. I'll come back on when the Johnny Carson portion starts. Tail of the tape. There we go. Taiwan dollar is plus 8% in 2 days. Hong Kong short rates are down 200 basis points in 4 days. There is a tie there. I'm not exactly sure how it works, but there's a rumor that rumor is not the right way to put it, but there's evidence that China may do something to. I don't know. Let's start over. Okay, Taiwan dollar plus 8% in 2 days. Hong Kong short rates minus 200 basis points in 4 days. Swiss 2-year bond yield now negative, chart 3. Japan 40-year yield at 20-year highs. Tel Aviv and Tehran stock exchange snapped to all-time highs. Big trade geopolitical shocks are driving painful deleveraging in the world. Happily and separately over in the US, global bank stocks, IXG, say Q2 policy pivot, US Q2 policy pivot, will be to lower tariffs, lower rates, and lower taxes. This is expected to prevent local liquidations outside of the US, mutating to global contagion. In summary, market indicators say he's still on a path for a pivot, as he mentioned in the last few weeks, and because of external market behavior as driving it. The price is right. I know he's a good general, but is he lucky? Lucky, B of A, FMS, uber bullish, December 17th, equals sell signal, uber bearish, April 15th, equals buy signal, semicolon. He's making the case cryptically that someone, or maybe the whole group at the global GFMS, the GFMS group, is nicknamed Lucky. But he's definitely making the case that the GFMS survey has been contrarian. May FMS on the 13th. So I guess he's saying stay tuned for that. Pain trade is still up if the FMS shows bear still consensus. Contrarian. Cash levels greater than 4.6%. But if global allocators back overweight stocks, rally stalls at key levels. ACWI, 120, QQQ, 500. Bottom line, GFMS contrary indicator is hot. Watch those levels. The biggest picture. U.S. trade deficit in March hit a record $140 billion. Chart 2. U.S. last ran a trade surplus in 1975. That is why the U.S. is now protectionist. But there's a flip side. The flip side is the big deficit. A big $540 billion of foreign inflows to U.S. assets in the past 5 years. If tariffs cause higher inflation and a weaker U.S. dollar, this is the worst case scenario that we alluded to, it would threaten funding of U.S. deficits via higher bond yields. Nothing reverses U.S. macro policy more quickly than risk of greater than 5% Treasury yields. Why tariffs will fall in Q2. Okay, this is actually an interesting statement. He's saying something that we've said before in different ways, and he said before in different ways. This is the cryptic language that we were talking about. He's saying that his policy predictions are they're going to back off either rates, tariffs, or taxes, right? So lower rates, lower tariffs, or lower taxes. He is saying, however, additionally, if you see that trade deficits flip side, the foreign direct investment, I'll call them FDI for this conversation. It's not literally FDI, foreign direct investment, I'm going to call it that. If the I'm not using the word right, but it's better for me. If foreign direct investment pulls their money out of the U.S., well, then Powell's going to be a little bit nervous, and there's no way he would cut rates, but that would be a very strong signal to back off on tariffs. So there you have it. Bottom line, trade deficit warrants protectionism in mercantile world, but for the U.S., it's still dependent on FDI, and that makes it risky. The worst case scenario concept comes to mind. He's warning of it being out there, but he will later on say that it's not here yet, which we already know. Next, weekly flows, $51.9 billion to cash. That went pretty easily. $14.1 billion to bonds, $2.3 billion to stocks, $1.3 billion to crypto, and $0.5 billion from gold. Continuing vindication that gold 2.0 is taking gold 1.0 money on the macro side. This is one reason you are not seeing macro discretionary pile into gold in the rally, because they don't buy things just because they rally. They buy things because it's asymmetrical, and there is not asymmetry in gold right now. It could go up, it could go down, but they don't see the tailwind that they saw last year. It's not easy money. It may be big money, but it's not easy money. For some reason, they see a tailwind in crypto, which you can see if you look it up, and that tailwind gives them a reason to go in. Flows to know, cash $51.9 billion, crypto $1.3 billion inflow, tech $1.2 billion inflow. Oh, we've got charts. Let's do those. Biggest 4-week inflow to crypto in 3 months. Yeah, I mean, I think that's technically true, but I think it's actually more important, and I say this bullishly, more important that after the increase, those big spikes we had dumps, but now we're back. So there really is, there's a bounce back to these flows. I'm biased, obviously. Chart 12, biggest tech outflow in 11 weeks. When's the last time you saw tech outflows combined with crypto inflows? I have never seen that. I haven't looked hard, but I have never seen that.